Thanks for listening to this audio summary of the October 2025 Assured Briefing. I'm Bill Wilt of Assured Research. This briefing consists of one longer business development note and a series of two-page notes on discrete topics. After the summary of our business development note, what I'll do is just share the title of the two-page note and then try to give you a bottom line takeaway from it. Now, this is a slightly new format for our briefing. Many of you will recognize that. So we'd invite readers, whether regular or new, to just weigh in if you have a view on this mix of one or maybe two slightly longer notes and a series of two-page notes. Love it, hate it, we'd like to know. Now, the business development note, that's written in mosaic style or researched in mosaic style, by which we mean what we do is we look to leading indicators from across the economy for insights into the health and growth prospects of the commercial insurance, mostly the commercial insurance industry, and organized by the major purchasing groups of commercial insurance. It's our thinking that a lot of companies are probably going through the 2026 planning period right now, and our goal is to be helpful and to remind that there's a lot of interesting economic and financial indicators that can be helpful to insurers in that planning process. So take, for example, construction and retail trade, which purchased some $95 billion of commercial premiums. Regular readers will know and recognize our graph, which shows the data from the Census Bureau that shows construction and retail and food spending. We adjust for inflation to show the real rate of change in those two series. And our work published earlier this year, going back to the early 1950s, showed that the prospects of those two industries are actually even more predictive than GDP as to giving information as to the direction of written premium growth. Unfortunately, after adjusting for inflation, retail spending is barely positive. It's at least positive. Construction, on the other hand, has been declining for more than a year, and it's been negative since it's been decelerating for more than a year, and it's been negative since late 2024. So, as an important person might say, that is not good. The real estate industry purchases about $60 billion of premiums. There we look at publicly traded REITs, real estate investment trusts, and compare how they're doing year to date. Bottom line, again, not so well. And the manufacturing industry, about $43 billion of commercial premiums. Some of you might be familiar with the Conference Board's monthly publishing of its leading economic index series. This is in turn underlying that index is a mix of building permits, weekly hours worked in manufacturing, new orders, consumer sentiment, stock prices, the list goes on. Anyway, it's a really useful tool, one would think, for understanding what's happening to manufacturing today. And as it's meant to be a leading economic indicator, it's been trending down for quite some time. The healthcare industry purchases about $40 billion of premium. Our main thought here is that the major cuts to Medicaid and the battle going on, as this is being recorded, about the premium subsidies and the Affordable Care Act plans, they're going to really influence the fortunes of the healthcare industry there too. Just in general, cuts to Medicare. Excuse me, if I said Medicare, I meant Medicaid. So an important distinction. But with cuts being made to Medicaid from the One Big Beautiful Bill Act, that's got to negatively impact the healthcare sector. And I'll end with just three broad themes. The wholesale trade sector is a really diverse sector. It houses everything from tobacco and beer wholesalers to toys and clothing. The economic prospects there are very much, one would think, going to be impacted by tariffs, the impact of tariffs. Similarly, when we look at the professional sector, finance and insurance, information, which we put those together, they purchase some $60 billion of premiums. Doesn't seem too soon to start thinking about the impact of AI and how it could impact their workforces, their growth prospects, and their margins. And concluding this note is the administration, accommodation and food and agricultural industries. Together, they purchase about $45 billion of premiums. There seems one central issue to be thinking about from a planning perspective. What's the impact of immigration reform on those industries where there's a lot of foreign-born workers in all three of those? So it's interesting, do we think, to observe that planning for property casualty becomes immediately intertwined with some of these major forces that are currently shaping the business world, our government, and frankly our society. But hope you enjoy that and get some value from it. So let's move on to our 2-page notes, where I'll just read the headline and then give you the bottom line. So property casualty industries are industry reserves, an important 5 months ahead for actuaries. Here, the bottom line is that the reserve studies in these next 2 periods, the third quarter and the fourth quarter of 2025, are really going to shape, we think, what happens in 2026. And it's kind of a good news is bad news kind of perspective. So the observation is there weren't many reserve charges in the first half of 2025. That's certainly good news. And it also suggests that, for instance, our fairly dire prediction for reserve deficiencies in the other liability occurrence line, maybe that'll prove wrong. And if it does, that's fine. That's certainly good news for earnings, good news for balance sheets. The bad news is that I think that that could, if it comes to pass, could weigh on the liability pricing cycle. Note 2, liability insurance, has the loss ratio distribution been reshaped? This is a calendar year perspective, and what we do is show that the hard market of the 9/11 era had a much more dramatic impact on the calendar year loss ratio distribution than we are at this point seeing now, at least a few years into the liability hard market. There's much less of a difference in the loss ratio distribution, kind of the before and after, and looking back at the 9/11 era, and before and say during the current liability hard market. Next is liability insurance reserving conservatism tempering the rate in excess of trend. So the question is, if rate's been exceeding trend in the liability business now for several years, why aren't the underlying combined ratios improving faster? One answer is we use the quarterly statements to show that the IBNR to case ratio on liability business, that's been rising steadily. Interesting and different work for us. Legal system abuse, an update to our social inflation dashboard. It's just that, an update to our dashboard through the first half of 2025. Bottom line is, it doesn't seem like legal system abuse is getting worse, which isn't saying a lot, but it's at least a start. And another, liability insurance state tort reform, a mixed record on loss ratios. So we looked back from the year 2000 and examined 7 instances of major reforms like those in Florida and Georgia recently. The bottom line is, maybe a bit disappointingly, is that the track record of those major reforms favorably impacting the liability burden, liability in relation to GDP or the loss ratios, that track record is mixed, more mixed than you might expect. Next, on reinsurance, the pivotal January 2023 renewal changed the loss ratio distribution. So we look at the ceded loss ratios across 3 property lines for the years 21 and 22, before the generational hard market of January 23, and then 23 and 24, again, ceded loss ratio distributions on an accident year basis. In other words, after that generational hard market, dramatically different distributions. It'll be immediately intuitive what happened in the favorable impact when you look at them. But it also highlights what's at stake as reinsurers are presently negotiating rate changes and possibly different attachment points ahead of the January 2026 renewal. And last but not least is a comparison of returns in the US and Canada. So new data from S&P Global allows us to compare the distribution of returns across property casualty companies on a statutory basis in both Canada and the US for 2023 and 2024. The bottom line is that the return profiles in Canada for at least these last 2 years have been more favorable than those in the US. So that's it. We hope you found this audio summary useful and it gives you incentive to open the briefing and read it. Please remember that we bold intentionally if that helps speed you through the review of our work. We definitely are inviting feedback on this newish format of mixing in a number of short notes in our monthly briefing. So thanks again, and have a great rest of your day.